Good afternoon, everyone, and a warm welcome to our webinar focused on navigating the 2025 private markets landscape. We'll just wait another second for a few more people to join. I see we already have a very high participation. Fantastic. I think we can get going. To start off things, just a very brief introduction about myself. I like to think of myself as a financial data geek. I basically studied how to use data and quantitative frameworks to improve financial outcomes. And it is because of this background that I got hired by Pantheon Ventures, where I eventually led the research department. Our mandate was very simple: use as much data as we can and as much evidence as we can to improve the risk-adjusted performance of our funds, primary, secondary, co-investments across all asset classes. And two things that became very apparent working at such a large LP is A, how hard it is to collect the data on private market investments on the one hand, and B, how to turn that data into better investment decisions. Of course, Pantheon being such a huge player, we were very well resourced to do these things very well. But with these ideas in mind, I thought it would be great to start a company that would make this data and these frameworks accessible to the wide LP community, which is why I co-founded Tamarix Technologies, which is a company that is single focused, has a focus on LPs, and in particular helps LPs manage their data and monitor their investments. And we do all of that thanks to the latest techniques in AI. As part of this experience and as part of my current role at Tamarix, I often come across LPs who are keen on understanding how to calibrate their portfolios in light of recent macroeconomic events. So what are we going to cover today? So first of all, we'll start with the latest data on the private markets outlook for 2025. Having done that, we'll discuss what implications these outlooks have for LPs in terms of liquidity management and pacing management. We will then put all these ideas and information into practice. I'll show you how we can leverage the latest data to calibrate your liquidity budgets and pacing budgets. And finally, we'll wrap up with a Q&A. In fact, we'll try to get to Q&A as quickly as possible to allow you to ask as many questions as you might have and tailor the session to today's attendance. Just a few rules for housekeeping purposes to make the experience easy for everyone. So you should see something like that in front of your screen. And in case of any technical issues, please feel free to insert the question in the top bottom. In the bottom right, there's an icon for a message for a chat. Please post your questions there in case you have any issues. And I will be asking you some questions. I'll be running shortly, two actually to be precise. And the push should be popping up in the bottom right part of the screen as well. But if you can't see it, if you just click on the geometric icons at the bottom right, which are circled in green, then you should see this activities panel popping up, and that's where the polls will be located. Just below that, there's a Q&A section. So if you have any questions throughout the session, please post your questions there. You can post them with your own name, but you can also post them anonymously. So whatever your preference is, do feel free to post questions there. And at the end of the section, we will be tackling your questions if we can. So let's start with the 2025 private markets outlook. This is where the first poll comes in. So just 1 second. Spend a second to think about what is your expected performance for new funds, the new PE funds, and let's be specific for the median PE fund in the 2025 vintage. Let me just start the poll. In particular, you should see it popping it up in the bottom right. In particular, I'm keen to get the pulse of how bullish you are on the median fund. So let's just give it a few seconds. We will share the results with the anonymously, of course, with the audience. So you might be interested in submitting your view so that we get as broad a sample as we can. I'll give it a few more seconds. See the votes are coming in. Thank you. 11 votes. I think we have another 10 to go at least. I'm sure we can get there. I won't bias you with the answers, and in fact, I'm asking you this question before showing you data on what the asset managers and history say about this question. Great, 14 questions answered, 14 votes. Maybe a few more. It's getting very tight between two answers, so we'll need a tiebreaker, I think. 5, 4, 3, 2, 1. Perfect. Let's end the poll. Interestingly, pretty much half of the respondents said between 0 and 10%, and half of the respondents said between 10 and 20%, which is roughly where I expected people to land. Nobody thinks that it's going to deliver less than 0. That's obviously why we are in this asset class. Nobody said it would be above 20%, which makes a lot of sense for the median fund. So let's try to compare this question and answer to some data. So if we look at liquid data, and in particular, we looked at all private funds that have invested been invested in the last 10 years, and we calculated the so-called horizon IRRs, then what we would notice is that in the 10 years to June 24, the average performance for buyout funds was around 16%. And for all other asset classes, except for private debt, the outcome was around 10%, slightly above or slightly below 10%. Private debt, of course, it's a lower risk asset class. The expected performance is likely lower than that level, and it's around 7%, as you can see in this graph. That's what history says. So very much aligned with the poll results. But what do the asset managers say on a forward-looking basis? Of course, one thing is to look at past data and understand how performance looked like on actual investments that have realized or partially realized. Another thing is to ask, what kind of performance can we expect going forward? So you might be familiar with the so-called capital market assumption. So outlooks that asset managers, both liquid and illiquid, publish regularly, typically at the end of the year or at the end of the new year, where they flesh out the outlook for different asset classes, and sometimes also flesh out the so-called capital market assumptions. These are specific estimates of the performance you can expect going forward. We like to look at these and compare them with historical data because they give you a more forward-looking perspective, hopefully accounting for regime shifts and other factors that might change how the asset class is done. Specifically, there are a handful of asset managers, both focused on liquids, illiquids, and multi-asset class, that have come up with estimates for private markets. And these are KKR, AQR, JP Morgan, PGIM, BlackRock, and BNY Mellon. So what we have done is we have extracted data from these reports, we have mapped it to uniform categories, and we have been able to produce this aggregate statistic. I will mention this at the end, but you can access to the entire underlying data set. I will share resources at the end so you can see how exactly each asset manager projected returns for each asset class and how we built this table. But focusing on this table, it looks like that for private equity, the forward-looking expectations are around 9%. So probably exactly in between your survey, and slightly lower than what we saw Preqin calculated for the last 10 years. Private credit, again, 6.7% lower than the other asset classes. Venture capital quite surprised me at 9%. I would have expected a slightly punchier estimate compared to private equity, but we can see that the difference is small. Interestingly, private real estate, everybody has been doom and gloom about real estate in the last couple of years, especially after COVID. I would have expected a bit more, a bit lower estimate, but this is what the average comes to, 7.6%, just a few percentage points below private equity. Private infra is on a similar level. Real assets are a bit lower. Now, the interesting thing always is how have these expectations changed year on year, because that gives you a bit of a sense of how the bullishness for the asset class has been evolving. So if we compare these estimates to the same numbers produced last year by the same asset managers, you would see that the big differences are on real assets, private real estate, and actually private credit and venture capital. So private equity is roughly in line with 2024, there's been a sort of deterioration of prospects on a relative basis for private credit and venture capital, whereas there's been a massive catch up in expected performance for real estate. This is one of the big takeaways from this table. Real assets equally have seen some of the expectations dampened versus 2024. Of course, these asset managers have different views, have also different products invested in these asset classes. So these are many other factors that have to be taken into account when judging these numbers. But I thought that like for like, this was an interesting evolution relative to last year. So what are the implications of this new outlook for LPs? Well, the reason why I organized this webinar is that people were incredibly interested about the latest views of asset managers on these asset classes, but mostly we're interested in a set of implications that they need to think about after reviewing these estimates. The first one is obviously, how should I review my base case? I have my models saying that I should be pacing my commitments at this speed, that I should expect this liquidity, that I should set aside this liquidity for calls. How do I think about changing my base case when it comes to this? And specifically, what exactly is the likely impact on my existing portfolio? How is that going to change across NAVs? What is the progression of my NAV looking like going forward? What kind of liquidity can I expect for the portfolio to generate? And what kind of calls can I expect in the coming quarters and years? And finally, how is my portfolio construction changing? Does this imply any change in the mix of my asset classes that might deviate from my target portfolio construction? So that's one set of questions. Importantly, what do I do with my portfolio? If the new outlook means that I should be changing my plan, what is that new plan that I should be putting into action? Should I make some secondaries, sales to trim the portfolio in some parts? Should I make new commitments? Should I speed up my commitments? Should I reduce my speed of commitment? So these are some of the questions that are often popping up, and they're all very much related to the outlook and to the modeling of private markets portfolios. So why do these questions matter? So I think there are mainly two costs of getting this modeling wrong. One is committing too little, and the other one is committing too much. So when it comes to committing too little, this is how often people think about making that mistake, how they can quantify that mistake. So let's just chat through it with an example. Suppose you have 1 billion AUM invested in private markets, just to make the numbers easy. And suppose you end up under committing and under allocating to private markets by 5%. Now, if you expect something like 300 basis points of alpha compared to public market asset classes, that's pretty much $1.5 million per year of performance left on the table. That's the cost of committing too little or being too late with commitments. On the flip side, what is the cost of committing too much? So suppose your target allocation is a sort of alternative variation of the 60-40 portfolio. So instead of having 60% in public equities and 40% in public fixed income, you have 50% in equities, 30% in fixed income, and that 20% that is freed up, you invest in private markets. Something that is probably not absurd for most LPs, especially for pension funds. I would say family offices and endowments, foundations might have a slightly punchier allocation to private markets and alternatives in general. But suppose this is your reference target allocation, and suppose you end up overshooting the private markets allocations, and this has been a problem in the last couple of years as the tide has turned in private markets. It's been a problem for many. So suppose you end up having an effective actual allocation of 30% to private markets. Now the question is, how do you finance that? Where do you take that extra 10 from? Do you reduce your public fixed income exposure? It's highly liquid, very easy to liquidate, but obviously that reduces your liquidity buffer and increases your risk budget. Or do you take it from public equities? Either way, in all cases, you end up being very much of plan in terms of your liquidity setup and risk budget. So this is the cost of committing too much, and we've seen a lot of that in the last couple of years. Again, because of the slowdown in private markets and public markets and the denominator effects and the like. But let's try to put all these ideas into practice. But before I get there, just thinking about the challenges that you might come across in getting this modeling right, I would like to ask you to post the second poll, which I'm launching now. You should be seeing it popping up in the bottom right. If not, again, if you click on the triangle, square, and circle and access the polls, you should be able to see the questions. The question is, what is hardest to get right in private market funds program? Is it getting the liquidity right? Is it getting the pacing right? Are both big challenges? Is everything easy and smooth? So go for it. We'll give it a few seconds. I see the questions, the answers are coming in. There's already a clear lead, but I think we still need to go with a few more votes to decide. Fantastic. Last 5 seconds. Let's do a countdown. We got 15 votes. There's a bit of a catch up on one of the answers. I feel like a Formula 1 commentator. Perfect. So let's end the poll. And the answer is both. There's a clear winner. Both liquidity and pacing are basically getting 50% of the votes. And then, interestingly, there's a split between liquidity and pacing for the residual voters. There's one person that said neither is a challenge. I hope it's a Tamarix user. If not, well done. Well, let's move on to how we can think about modeling it. So we are big fans of the Yale model. So the Yale model, otherwise known as the Takahashi and Alexander model, is a model that was developed by Alexander and Takahashi, who were running the Yale endowment around the beginning of 2000s alongside Swensen. And obviously, one of the big questions and challenges they had day in and day out was, how should I pace my commitments to make sure I hit my portfolio construction goals, my target allocation goals on the one hand? And secondly, how much liquidity can I expect to recycle, and how much liquidity should I set aside for calls? So they developed a model that is deterministic, but very simple to understand, use, flexible, and it's been basically used by the majority of LPs ever since. So what are the inputs and the outputs? Let me chat you through them quickly. But these are the inputs to the model. So first of all, it's very important to determine how long you expect the fund to live for. This in turn is fundamental to determine how the profile of distributions over time. Second input that is key is the call rate. So how much do you call every period as a percentage of unfunded commitments? What is the bow factor? Bow factor is one of the most mysterious parameters of the model. You might have come across it in multiple contexts. The way I think about it, it is a proxy for duration. So the higher the bow, the longer the fund waits to distribute cash back to its investors. So by controlling that parameter, you kind of decide how quickly and how early in the life of the fund distributions are starting to be made and progressively increase as the fund approaches liquidation. Then obviously you have two very important parameters, the target IRR, which ends up being the growth rate period by period of the NAV. It's tightly related to the changes in fair value, and the target yield for yield-generating asset classes such as infrastructure, real estate, private credit, of course. So these are the inputs. You can set them for each underlying fund in your portfolio. You can set them by strategy, and this is the sort of output you get out of it. So the important things to note is that you get output that is kind of covers the main metrics of the model, or what you would expect the private fund to generate. So you can generate calls per period, calls since inception, distributions per period, distributions since inceptions. You have a NAV profile being generated. You can split out yield and non-yield components. You can see how your unfunded evolves over time. In other words, every metric you might be interested in modeling, you got it covered. And secondly, these curves are very sensible, so you can see how calls, which are in pink on this curve, start relatively steep in the early part of the fund's life and slowly approach 100% of committed capital towards the very quickly around year 5, and then progressively call a bit more for the usual expenses and management fees, which is consistent with what we observe in practice. Distributions are very low at the beginning and then spike up around the half of the fund's life. You have an NAV profile that increases in the early part of the fund's life and then starts decreasing, an inverted U. So all the kind of patterns that you would expect, which you can then edit and customize to your portfolios based on the input parameters you generate. Another interesting property of this model, which is something that in modeling people struggle with a lot, is that it is adequate for both existing investments and new investments. So in this graph, we're showing you the profile for a new investment, but obviously you could project forward from a fund that is, say, 3 years old and has already called capital and distributed capital. And the model blends in very nicely with historical data and projects from the latest set of capital accounts effectively. I'll skip this for a second. So let's come up with an example on how to use it. So suppose we have a portfolio of 31 investments. And these investments currently have an NAV of 64 million. And let's assume that the target that I want to achieve with my private markets portfolio is 100 million. And let's assume that in 2024, I set everything. I decided that I should be committing 30 million per year, because that would allow me to catch up with the gap in NAV versus my 100 million target, and then allow me to maintain that exposure going forward. Now, let's see what happens. So suppose that in 2024, I thought I was very bullish about buyouts. I thought my average buyout would deliver a 15% IRR, a 1.8x TVPI, and that would call my unfunded at a rate of 10% per quarter. And likewise, assume that my venture capital assumptions were 20% for IRR, 2.3 TVPI, and 10% call rate. Those were my assumptions in 24. And all of a sudden now I've seen a new outlook. I've thought about carefully my investments. I've decided to take some historical data. I thought about my forward-looking expectations, and I've come to the conclusion that I should be reviewing my assumptions as follows. For buyouts, a bit of a haircut, 5% less IRR, 1.5 instead of 1.8 TVPI, and a higher call rate. This would be a scenario where you're becoming a bit more bearish on your private markets portfolio, and at the same time, you think you might be faced with a higher call rate, which is the experience that many have had in the last couple of years. And similarly with venture capital, a bit of a haircut to my performance expectations and an increase in my call rate. So I'll show you how that kind of change in assumptions might impact your cash flows and NAVs using the Takahashi Alexander model and that example that I've shown you. And I'll show you a few screenshots from our platform, but obviously you can kind of go through the exercise of replicating on Excel as well. So let's start with the J-curve. Very important. So this is what the J-curve looked like with 2024 assumptions. So we were kind of expecting a break-even in June 26, and we expected a 48 million surplus cash being generated by December 2028 with the old assumptions. Now, as I shock the system with new assumptions, this is what's going to happen. There's 1 quarter delay in my cash flow break-even point, if you like, where the J-curve crosses 0. Not a big deal, but you start seeing that there is a reduction in the distributions, a relatively significant reduction in distributions by 2028. What is the impact on the NAVs? So this is what it looked like before. What we do here, we distinguish between, in blue, the roll-off of NAV on the existing portfolio, which, as I mentioned, imagine it's around 60 million NAV to start with. And in yellow, I show the impact that new commitments have on the total exposure. And you can see that there is a nice ramp up in total exposure with that 30 million per year commitment pace, which ends up breaching slightly the 100 million target by 2028. That's with the 2024 assumptions. Now, with the new set of assumptions, 2025, you can see how actually you end up overshooting even more the target that you had. And I think this was a very interesting result to observe, which seems to be a bit striking at the beginning, because we have lowered our expectations for 2025. How can I end up having more NAV than before? And the reason behind that, the logic behind it, is that in resetting the assumptions, we increase the call rate. Even if we cut down the performance, we give it a bit of a haircut. We also increase the call rate, and increasing the call rate means that capital is getting called earlier and has more of a chance to accumulate through the compounding effect of IRR. At the same time, the lower performance estimate means that it's gonna grow less quickly than in the previous scenario. So it's not clear before actually running the calculations which one of these two effects will be dominating, which is why I think it's very important to think carefully about the modeling, because oftentimes what you would expect happen is not as intuitive as you would think. And this is a clear example of that observation. Of course, this was an incredible simple toy model. In the real world, things are much more complicated. So first of all, on scenarios, you really need to come up with a set of different scenarios to really do this modeling exercise properly. So not only think about a baseline case, but you should also think about a downside case and an upside case. A downside case that many people are keen on is, let's think about a scenario where there's a massive reduction in distributions, a ramp up in calls, and at the same time there's a haircut to expected performance. That's one scenario that many people are quite keen on. But in general, you should think about what the worst case scenario means to you and come up with a scenario that reflects that. And you can do the same thing with an upside scenario. Then you should really think how to balance historical versus forward-looking, historical data versus forward-looking expectations, and understand where the right blend is. One example that I often say is, well, when it comes to buyouts, you have a lot of historical data. You should use historical data. When it comes to other asset classes, such as private debt that have lived for fewer vintages, it probably makes more sense to rely on forward-looking data. At the same time, there are corner cases. So the best example, even with buyouts, is the usage of facilities. If you sort of base your, if you calibrate your call rates based on the historical call rates of buyouts, pre the usage of facilities, you will see a drawdown profile that is really off to the drawdown profiles that buyout funds are actually living through at the moment. So you need to really balance these considerations carefully, depending on the asset class you're looking at. Obviously, there is a lot to be done then in terms of top-down versus bottom-up modeling. So typically, people kick off with a top-down profile by strategy. I showed you buyout and venture, but obviously you can do that for broader asset classes such as PE, infra, private debt, and so on and so forth, or sub-stages that are more granular, small, mid US buyouts. So that is one approach. But the reality is that as funds mature, they are more likely to deviate from the average profile for that category. So as funds become older, you should recalibrate scenarios to be more fund specific for the type of investments that you have in your portfolio. So that's a very important consideration as well in actual implementations. In terms of metrics, there's, I've shown you J curves and NAVs, but obviously you might want to have a more specific run through granular metrics such as calls, distribution, yields, depending on your objectives. And then in terms of analysis, I've shown you what can be done with liquidity and pacing, but obviously there's higher dimensional questions to be addressed. For instance, if you have a specific target allocation across different sub-asset classes in private market, say I want to have 50% venture, 50% buyout, then you should also think about how to project the relative NAV of these two sub-asset classes and understand whether pacing may be required, tweaks to pacing may be required to make sure you align with that objective. So wrapping up, we discussed how CMAs, so capital market assumptions, can be helpful to flesh out the outlook and be used as inputs to your considerations when recalibrating your private markets programs. We thought about what this means for LPs, especially in terms of liquidity management and pacing optimization. We discussed how you can use the Yale model to instrumentalize these ideas and come up with sensible scenarios. And we showed you an example of how to do that in practice. A lot of what I talked about today is available online in an extended form. So we have published a few blogs that you might find interesting if you found this content interesting. So first of all, a practical guide on how to use the Takahashi Alexander model in practice, how to calibrate it. Secondly, a general framework on how to think about pacing and liquidity management. And then finally, we compiled, as I mentioned, the private markets outlook forecasts in a separate blog, and you can access the Excel with the split out of forecasts by individual asset manager. So that's a handful resource if you want to dig a bit deeper. Of course, if you also need some help on doing this in practice, setting up a software system to automate all of this and make your life easier, please do feel free to reach out to me. This is what we do at Tamarix. And with that, we can look at the Q&A. So I'll open the Q&A session now. I don't have any questions yet, so hopefully this is not due to a technical issue of people not being able to submit questions. But if you want to ask a question, again, if you go to the bottom right, you will see three geometric shapes. If you click on that and go to Q&A, you can pose questions, also anonymously, by the way. I'll give it a minute. Let's see if there's somebody brave. That's the first one. I don't think so. Looks like there are no questions. But obviously, feel free to reach out to me directly after the webinar if you have any specific queries. We can pick it up separately. And also, we will follow up with an email pointing you to the resources and to the deck in case you want to take a second look. So with that, I'll thank everyone for attending and wish you a good evening.